When you think dividends, you probably think cash, right? Cold, hard cash sitting in your account. But what if a company decides to get creative? What if they pay you in, say, property or equipment or even shares in a different company? Yeah, that's where things get complicated. And that's exactly why we have a special rule called IFRC 17 to sort it all out. So let's just jump right in with a scenario. Picture this. A big, successful real estate company wants to reward its owners. But instead of a cash dividend, they decide to give everyone a building. Like, here are the keys to a brand new condo. How on earth does the company account for that? What's the real value of that dividend? That's the core problem IFRIC 17 is built to handle. The official accounting term for this is, well, a bit of a mouthful. Distributions of non-cash assets to owners. It's really just a fancy way of saying you're paying people with stuff instead of cash. The idea itself is simple enough, but the accounting? That's where it gets tricky. I mean, cash is cash, but the value of a building or a bunch of shares? That can change from one day to the next, and that creates some serious accounting headaches. All right, so here's how we're going to break this down. We're going to tackle 3 big questions at the heart of IFRIC 17. First, when do you actually record this thing? Second, how do you figure out what it's worth? And third, what do the books look like when you finally settle it? After that, we'll touch on reporting and why transparency is so important, and then we'll wrap it all up. Okay, let's get into it. Question number 1, when to recognize? I mean, when does this promise actually become a real official liability on the company's books? And believe me, in accounting, timing is everything. And the rule itself gives us a pretty clear answer. The liability gets recognized when the dividend is appropriately authorized and is no longer at the discretion of the entity. What does that actually mean? It's the point of no return. It's the moment the company can't back out anymore. They are legally on the hook to deliver. Now, that point of no return can happen at 2 different times. And it all depends on the company's rules and local laws. So, if you need shareholder approval, the magic date is when the shareholders actually vote yes. That's when it goes on the books. But if no approval is needed, it's official as soon as the board or management declares it. Simple as that. All right, so we've figured out when to record the liability. The next logical question is, for how much? How do you put a number on this promise to hand over, say, a building? And the rule here is super clear. You measure the dividend at the fair value of the assets you're going to hand out. Now, this is a really important point. We're not talking about the asset's original cost or its value on the company's internal records, the book value. We're talking about its market value. What could you sell it for today? But, things are rarely that simple. What happens if the company gives shareholders a choice? You can have the asset, or you can take a cash alternative. Now you've got a whole new layer of guesswork, right? Because you don't know who's going to pick what. So to deal with that uncertainty, IFRIC 17 gives us a 3-step plan. Step 1, figure out the fair value of each option, the asset and the cash. Step 2, you have to make an educated guess, a probability of how many people will choose each one. And finally, step 3, you mash it all together to get a single weighted average estimate for the total dividend you owe. And listen, this isn't a set it and forget it kind of deal. The market value of that asset can go up or down, right? So the company has to review and adjust this liability at the end of every single reporting period until the dividend is actually paid. And here's the interesting part. Those changes don't hit the income statement. Instead, they're adjusted directly within equity, which is kind of like the company's net worth. Okay, so we've nailed the timing and we've put a value on it. Time for the final act. Question 3. How do we settle this thing? This is all about the journal entries on the day the company finally makes good on its promise and hands over the asset. So on the big day, settlement day, you've got 2 numbers you need to look at. First, there's the asset's carrying amount. That's what it's worth on the company's own books. And then you have the dividend payable. That's the liability we've been tracking at its fair market value. And let's be real, it's almost a guarantee that these 2 numbers won't match. So what happens with that gap between the 2? This, right here, is the real kicker. IFRIC 17 is very clear. That difference goes straight to the profit or loss statement. Think of it like this. It's as if the company sold the asset to its shareholders for fair market value. So the difference between its book value and that market value, that's a gain or a loss, and it hits the income statement for everyone to see. Look, a deal like this has a lot of moving parts, a lot of estimates. It can get messy. That's why the final piece of this whole puzzle is all about transparency. The rule has very specific disclosure requirements to make sure investors aren't left in the dark. This standard basically demands that you spell everything out. That gain or loss from the settlement, it needs its own separate line item on the income statement. You also have to show the dividend liability at the beginning and end of the year, explain how it changed, and even talk about dividends you've declared after the year end. The goal is simple: no confusion. All right, I know that was a lot of technical detail. So let's zoom out and boil this all down to the absolute essentials. Think of these as the IFRIC 17 rules of the road. If you remember nothing else, remember these 3 things. 1, you recognize it when the company can't back out. 2, you measure it at the asset's current fair market value. And 3, when you settle it, that difference between book value and fair value, it goes straight to your profit or loss. That's the core of it. So why does any of this matter? You might look at IFRIC 17 and just see a bunch of dry technical rules. But it's really about something much bigger. It's about fairness, and it's about reflecting reality. It makes sure that no matter how a company decides to pay out its profits, the financial statements show the true economic impact of that choice. It gives every investor a clear, consistent view. And in our complicated financial world, that's a pretty crucial guardrail to have.